Well, India is the best story for the next 10 years. That's the word coming in from none other than global guru Christopher Wood in an exclusive chat with ET Now. He says that India dominates their long-term portfolio of 20 stocks. Meanwhile, US struggles with the risk of recession.
Chris has been a long-term India bull, and over the years, the portfolios which he has advised to his clients has always had a overweight rating on India. But given the recent bout of outperformance and where China seems to be headed, is it time to now go market weight on India? And how should one read into the current risk on rally? Chris, fantastic to have you back, and thank you for joining us.
Thank you, thank you for having me. So you're raising to address the point you just raised. It's clearly the case that in the recent weeks and months, India's valuation over China has reached unprecedented levels in terms of the India having been remarkably resilient during this year of monetary tightening. When I say India, the stock market, whereas in China, we've had a lot of body blows. So tactically, there's definitely a good case to reduce India and add to China, and there has been for about the last month. But structurally, I still remain firmly of the view that India is the best story and a 10-year view in equities, in Asian emerging market equities.
Chris, the first half of the year, this calendar year, was dominated by fear of rising interest rates, fear of a slowdown, and there was a geopolitical tension as well. But the second half of this year looks like all the concerns are getting diluted. Do you think the world has seen the peak of inflation and peak of interest rate hike?
Not well. What I wrote in my most recent quarterly was that we were near the peak of monetary tightening expectations and US dollar strength. That was at the end of September. What I wrote about 2 or 3 weeks ago in the Greed and Fear Nikunj is that my base case, my guess, is that monetary tightening expectations peaked with the last press conference by Fed Chairman Powell following the last FOMC meeting. I'm not saying there will not be more rate hikes. I'm saying the monetary tightening expectations in the money markets peaked. And if that proves indeed to be the case, it's likely to mean that the US dollar has peaked. But the one caveat to my base case is if we got real material escalation in Ukraine and there was another surge in energy prices, then, on that basis, I would be wrong. But in the absence of that, that's my base case. I'm not saying inflation is going to collapse. I'm saying inflation has probably peaked for now. But my other base case is at some point in the first half of the year, the Fed will fudge its 2% inflation target. What do I mean by that? I mean it will stop tightening even though inflation has not yet reached 2%.
But Chris, if interest rates have peaked out and if there is a fear of a recession, do you think equity markets have not factored that in? As of now, equity markets, at least global equity markets, have rallied when they got a sense that interest rates are nearing its peak and when they got a sense that US CPI inflation had peaked out. But do you think somewhere markets are not right now factoring in chances of a earnings decline and possibility of a recession in Western world?
That's exactly right. So if you're talking about US equity market, I completely agree with you. The markets have started to price a peak in monetary tightening expectations. Not completely, but they've started to price that, which is why we've had this rally. And oftentimes, equity markets rally into year end, calendar year end. That is normally what happens, most particularly when you've had a year of big declines in prices. But I think this year, the issue facing equity markets was monetary tightening. That's why the high PE growth stocks were the most vulnerable. But next year, I'm talking US market here, next year the issue for the US market is the overwhelming risk is earnings downgrades given there's a growing likelihood of a recession, given we've had very aggressive monetary tightening this year, and monetary policy works with a lag. So the best way of capturing the earnings downgrade risk is that S&P 500 listed companies' profits are trading a 20% premium to the macro measure of corporate profits in America, published quarterly by the Bureau of Economic Analysis in the US. Traditionally, when you have such a divergence between the macro measure and the listed quoted companies' profit measures, what happens in a downturn is the listed companies' profits converge with the macro measure. Yeah, so to me, that's the risk for equities next year. But right now, in the short term, the markets can celebrate what they hope will be the peak of monetary tightening expectations. As I say, I'm saying monetary tightening expectations have peaked. I'm not saying there will be another rate hike by the Fed, though.
Chris, early in the November, there was a big comeback in Chinese equity markets and China A shares on Hang Seng. Given that China is revisiting COVID restrictions again, how do you see Chinese stocks moving, and what impact do you think that will have on emerging markets?
No, but actually it's wrong to say China's revisiting COVID restraint. China never formally ended its COVID policy. All China has done in recent weeks is signaled a gradual relaxation of that COVID policy. So I believe there is a gradual relaxation going on, but I have to emphasize the key word is gradual. So right now we have surging COVID cases in China, but we do not have cities being completely locked down in response to that, like we had in Shanghai earlier this year, but we have all kinds of restrictions on activity in these cities. So it's a nuanced policy. It's certainly not a complete opening. So the best reason to have taken a more constructive attitude on China equities this year in terms of this quarter in terms of the COVID policy is the simple fact that President Xi has since October started appearing in public without wearing a mask. So to me, that's an important signal. Now, the other thing that prompted this rally in Chinese equities was I was expecting the Chinese government to come up with a sort of central government to come up with a package or a policy initiative to try and address the issue of these unfinished residential property projects because the private sector developers didn't have the funds to complete them. And we've seen in the recent weeks a package trying to get more liquidity into these private sector developers. So that's the reason for the big market rally. But it doesn't mean to say that China's fully opened up. And the trillion on a 3 to 6 month view, the key issue will be whether the Chinese middle class will be willing again to buy properties from private developers, because confidence has been badly damaged during this year.
Chris, you've been a long-term India bull, and even after the recent run-up, if I look at your current recommended weightage, you're still overweight on India. What will prompt you to bring that weightage down, and what in a sense would be important for you to maintain or increase this weightage?
No, my weighting is marginally overweight because the neutral weighting's gone up a lot. So my relative return portfolio, I'm marginally overweight China and India. But in my long-term absolute return portfolio, I have about 20 stocks. It's still dominantly India because that's long-term. So the more short-term you are, the more you should want to underweight India. The more long-term you are, you should just stay structurally overweight. It all depends on your time horizon. But I think the key point about India so far in calendar 2022 is just how remarkably resilient the stock market has been in the face of negative correlation offshore, given the decline in US share prices, and in the face of quite significant monetary tightening in India.
Chris, if I look at your long-term thematic portfolio, and especially look at the ideas and the names you like in India, you've always liked private banks. There is a bit of insurance play then in real estate. But I don't see too many consumer names or for that matter, any exposure to IT. Why is that?
Well, because I mean, this is a 20 stocks in Asia, so there's a limit to how many names I can have in India. Well, I've got nothing against owning. The IT names have been got a boost. That business model's got a boost from the pandemic, and I've got no problem with the consumption names. It's just a question of choice. But for me, the key positive development in India in the last 2 years has been the ongoing evidence of a continuing property rebound in the residential property sector, which has all kinds of positive multiplier consequences for the economy. So that's the key development. I think that explains it to a significant extent, the market resilience this year. And I'm hearing a lot of anecdotal noise of growing hopes that, you know, the private sector, with the corporate debt having been significantly come down in recent years, the balance sheets cleaned up, with the last NPL cycle now behind us, the odds are growing for growing evidence of a capex cycle. Meanwhile, there's another positive long-term story for India, which is now increasingly visible, which was not visible in the last 5 to 10 years. And that is the growing hopes that India can attract significant amounts of foreign direct investment in the manufacturing area as a result of the natural desire of corporates to move production out of China. In the last 10 years, the country that benefited most from this so-called China plus one strategy has been Vietnam. But going forward, it seems to me that if India can come up with a credible policy to attract manufacturing, which it appears to have done with this production-linked incentive schemes, India has one unique advantage over these Southeast Asian countries. It offers access to a big domestic market on a 20-year view with strong demographics.
Chris, what would you tell the naysayers who are of the view that India is a great story, but valuations are not strong and supportive? It is like saying that you're buying perhaps gold at the price of diamond.
What do you mean? The naysayers are saying what? That it's too expensive?
Yes.
Hello?
Yes. So what would you tell the naysayers who are of the view that India has got a strong economic engine going for itself, but the stock market or equity market valuations are expensive?
No, look, there's no doubt the valuations have been expensive, are expensive relative to history. But compared to the valuations prevailing in the US in the last several years, they're not so expensive. So it's all relative. But I would say first and foremost that the market has been extraordinarily resilient. It's had two tests this year. It's had a record foreign selling in the first 6 months of this year, and it's also had it's also faced more monetary tightening than was anticipated at the start of this year. So actually, the resilience of the stock market is very pronounced, and basically, this has been a year of consolidation. But it's not like one shouldn't think India is the best performing market in Asia this year. The best performing market is actually Indonesia, which I've also been overweight all year. So this is a year of consolidation where India has behaved very well in the context of monetary tightening and negative Wall Street correlation. So when I met you, I believe I was in India in April. When I met you, all my Indian contacts in the investment industry, virtually all of them were expecting a significant correction in the Indian stock market this year, and so far that has not happened. So that shows the resilience.
Chris, we've seen a absolute selling rout in global internet stocks, global technology stocks. Do you think the selling in some of the new age technology stocks, both in India and also globally, is unjustified?
No, that was always going to be the risk if we had a monetary tightening cycle. And actually, the monetary tightening cycle has been more aggressive than I would have anticipated this time last year, because they're not only raising rates, they're engaging in balance sheet contraction. And I think the Fed has been under political pressure to address the inflation issue. And that political pressure came from the Democrats, because they suddenly realized that inflation was the number one. They realized a year ago inflation was the number one issue on the opinion polls for Americans. And as importantly, the opinion polls showed, rightly or wrongly, that the Biden administration was being blamed for the inflation. So the word went out on the Fed to be seen to be doing something about this ahead of the midterms. So the monetary tightening has been more aggressive, and all the that has been very negative for the profitless tech thematic, also being very negative for crypto. And we've seen FANG stocks start to break down. So FANG stocks market share FANG stock share of S&P market cap peaked in the summer of 2020, is now breaking down quite sharply. I'm firmly of the view that the FANG share of S&P market cap will continue to come down so long as monetary tightening is happening. There will be relief for the new technology and the crypto space. I think this area is a long-term story, but the relief will come when the monetary tightening ends, or is seen to be ending by the market.
Chris, exactly a year ago, the template for global financial markets was interest rates will remain low, inflation was transitory, and central banks will not interrupt the money printing cycle. Today, the fear is interest rates are rising, inflation is stubborn, and more than growth, there is a fear of recession. So a year forward from here, which is November 2023, what do you think could be the market narrative?
Oh, well, the key point right now is money supply growth, which surged in 2020, US M2, which was the cause of the inflation we saw in the last 18 months. So I was expecting the surge in inflation because I saw the big surge in US M2 growth. But right now, the story's changed. As I wrote in my Greed and Fear that was published overnight, US M2 growth is now collapsing. So that collapse in US M2 growth has negative implications for the US economy and US asset prices next year. But it also creates the potential for a dramatic U-turn in Fed policy at some point next year, where they go from raising rates to cutting rates. So my base case is that the Fed will be cutting rates in 2023. And to me, the question is whether it's going to be a second quarter or a third quarter affair.
Chris, in your mind, what exactly are markets pricing in on the geopolitical front? 3 months, 6 months, do you think markets are factoring in a end of the war? Do you think there could be some resolution to what's happening between Russia and Ukraine? Is that a template? Is that a factor markets are working with?
Well, the markets can't discount geopolitical issues. They have no, so they only react to geopolitical issues when they're hit in the face by them. But to me, there's, the big risk to my base case that monetary tightening expectations have peaked. The big risk is is escalation in Ukraine. But if that's the risk, the other possibility, which is a bigger possibility as escalation, is sudden resolution of the Ukraine conflict, which would then lead to a risk-on rally and would lead to oil, my guess, correcting quickly to the $70 level. So as the winter kicks in Europe, and some of the costs of this European policy on Ukraine kick in, there will be people arguing that there should be an attempt to resolve this Ukraine conflict.
Yes, I distinctly remember when we interacted with you earlier in the year, your view was that growth stocks will peak out and value stocks will make a comeback. And I guess that was and that has played out wonderfully well. So my compliments on that timing of that call. My next question is that if you are of the view that interest rates have peaked out and bond yields have peaked out, do you think somewhere in 2023 growth stocks will start making a comeback?
No, they will, but the key question is, does the Fed stick with its tough monetary tightening until inflation actually gets to 2%? Because in that case, equities are going to come under a lot more downward pressure, and you'll be better off owning government bonds. But in a world, which is my base case, that the Fed fudges its 2% target and starts backing off tightening well before we reach 2%, that is a world where government bond investors suddenly realize the Fed may tolerate a higher level of inflation, and that is a world where equities become more attractive than bonds. But on my second base case, you're going to have to own both cyclical stocks and growth stocks.
Chris, could there be a potential comeback in commodities, whether it is on account of China or whether it is because of interest rates peaking out? Somewhere in 2023, could there be a reflation trade in across the board commodities?
There's going to be two countervailing forces for commodities. The negative is clearly the demand destruction risk from a recession in the US and Europe. That's a real risk. But the positive is a hope for more full opening of the Chinese economy. So to me, by second quarter next year, even if the COVID cases surge during the winter, the upside of that will be that there'll be greater immunity, vaccination rates will be rising all the time. So by the second quarter of next year, China really should be looking to more full-scale opening. So we could get China opening more soon in a more real way, at the same time as recession concerns are escalating in the West. So we've got both a positive and a negative for commodities. So it's not so straightforward. But in the case of oil, you have a structural underinvestment in oil because of the lack of investment as a result of the political attack on fossil fuels in the developed world, which has created this structural shortage, which means that oil is maybe more resilient in a downturn than in previous economic cycles.
So I'll carefully divide my next question in three parts. For next 6 months, which asset class do you think could underperform and outperform? What would you advise our viewers to hold on for next 3 years if they're looking at a structural bet? And 5 years beyond, what would you say is a must-have in everyone's portfolio?
So, your first question was 3 months.
That's right, 3 to 6 months.
Hello?
Yes, sir, 3 to 6 months.
No, the 3 to 6 months is probably the risk reward favors buying some Chinese equities, simply because they should be fully opening by the second quarter of next year. But you should understand that they're not fully opening right now if you make that bet. But Chinese equities are cheap. And your next question?
3 year plus and 5 years plus.
And I also like Japanese equities. I think right now Japan and Chinese equities are attractive. On a 6-month view, if you believe my fudging of the 2% target story, if you believe that, what will be extremely sensitive to any hint that the Fed is going to inflation reaches 2%, that is an area where gold and silver will get traction. On the 5-year view, I'm staying with the Indian story, Indian equity story.
Chris, I'll wrap today's interaction with the title of your newsletter, Greed and Fear. So at the current juncture, where do you think there is greed in the market? Which asset class, which market, or which sector currently is hit by greed? And where do you think in the world right now there is excessive fear or skepticism?
Oh, well, there's no doubt the greatest fear right now today relates to the crypto space, which has sustained some serious body blows. And there's clearly huge legitimate concerns about further negative ripple effects. But actually, personally, I'm surprised that Bitcoin has not declined more given what's been going on, because there's been some pretty shocking developments. So that's undoubtedly where the greatest fear is. Probably the greatest greed is still in the private equity, private lending space, because this is the area which has been least impacted by what's been going on in terms of monetary tightening.